This is our macro video on monetary policy. Monetary policy is the action the Federal Reserve takes to manage the money supply and interest rates to pursue macroeconomic policy goals. The four main goals for monetary policy are price stability, high employment, stability of financial market institutions, and economic growth. Inflation is the rate at which price for goods and services is increasing and the purchasing power of currency falling. This is bad for consumers, for it raises the price level of products. The three tools are discount policy, which is when a bank borrows money from the Fed by taking out a discount loan. The Federal Reserve requirements is when the Fed reduces the required reserve ratio. It converts required reserves into excess reserves. And the open market operations, which is the buying and selling of Treasury securities by the Federal Reserve in order to control the money supply. The targets for monetary policy are money supply and interest rates. A decrease in the interest rate causes an increase in the quantity of money demanded. When the Fed decreases the money from MS1 to MS3, the equilibrium interest rate rises. When the Fed increases the money supply from MS1 to MS2, the equilibrium interest rate falls. Expansionary monetary policy is used during a recession when the Fed takes actions to decrease interest rates to increase real GDP. Contractionary monetary policy is used to increase interest rates to discourage inflation. When a recession begins, the Fed implements expansionary policy, not realizing the recession is actually over. The Fed policy causes too large an increase in aggregate demand, increasing the inflation rate. Inflation targeting is the framework for conducting monetary policy that involves the central bank announcing its target level of inflation.